Hey everyone, welcome to this explainer. Look, as a financial news host, I'm here today to give you a real educational blueprint on the 2026 AI market. We're talking massive potential, sure, but also some critical risks, and we are looking at this strictly through the lens of long-term capital preservation. There is just so much noise out there right now, so my goal today is to cut right through it, using hard data, so you can see exactly what's actually happening in the market.
Okay, $1.8 trillion. Let that sink in for a second. That is the projected size of the artificial intelligence market by the year 2030. To put that into perspective, we're looking at a staggering 37% compound annual growth rate. This isn't just your standard tech cycle. People are calling it the absolute biggest investment trend of the decade. But, with that kind of explosive growth comes major volatility. So we've got to unpack that risk. Here's our agenda for today. We're covering big tech's CAPEX catalyst, navigating AI bubble risks, the top 5 AI stocks, risk management with ETFs, and finally, leading the AI revolution. Let's get right into it. Section 1. Big tech's CAPEX catalyst, the macroeconomic driver of the AI boom. The reality on the ground right now is just staggering. We're seeing a massive 62% year-over-year jump in AI capital expenditure. That's from heavyweights like Microsoft, Amazon, Google, and Meta, pushing well past $405 billion. This isn't just some speculative VC money hoping for a lucky break. No, these are the most profitable tech companies on Earth putting their own cold hard cash on the line to build the physical infrastructure of our future. So why does this matter to you? Well, this massive influx of infrastructure spending is your long-term indicator. It's the catalyst signaling genuine, sustainable AI growth. It tells us that long before we even see a shiny new AI product, billions are flowing right into the value chain, and that heavily benefits the semiconductor chip makers, the cloud providers, and the enterprise software platforms. Section 2. Navigating AI bubble risks, valuations, concentration, and monetization.
All right, before we even think about individual stock picks, we absolutely have to talk about the elephant in the room. The growth is real, sure, but we've got to be objective about market pricing. Experts like Hadar Habba over at Andra Capital warn that AI is often used as a buzzword just to pump up share prices, and honestly, it remains completely unclear if a lot of that potential will ever actually be monetized. Add to that, Bank of America points out that S&P 500 tech valuations are stretched incredibly thin right now, trading at about 27 times forward earnings. That basically means you're paying a steep premium today for profits you're only hoping to see tomorrow. This demands a highly disciplined approach.
If long-term capital preservation is your goal, and it should be, understanding these core risks is vital. We're looking at historically elevated tech valuations and super heavy market concentration, meaning the broader market success is basically riding on just a few megacap stocks. Plus, there's that lingering uncertainty around return on investment. Like, how fast can big tech actually make their $405 billion spend back? And lastly, we're definitely seeing some bubble dynamics in highly speculative areas. Companies with zero proven product market fit.
Section 3. Top 5 AI stocks. Exploring the core companies powering 2026.
Keeping those risks in mind, this gives us a great holistic wealth management snapshot of our top 5 players. We can weigh their dominant sectors against their growth metrics and, most importantly, their current valuations and risk levels. As you can see, we've got a really interesting mix here of hardware giants, cloud behemoths, and pure-play software.
Let's start with the undisputed heavyweight champ, Nvidia. They are essentially the bedrock hardware investment of this whole boom. Their GPUs currently power around 80% of global AI training workloads. 80! And what really protects them is their deep economic moat. It's a tightly integrated ecosystem of hardware and their proprietary CUDA software, which is the actual code making these chips run. Competitors are finding that almost impossible to crack. With a projected 67% annual earnings growth through 2027, they are the absolute backbone here.
Next up, Microsoft, the reigning enterprise AI leader. Honestly, they represent one of the safest paths to AI exposure out there. They are doing a brilliant job monetizing their software suite globally by baking open AI tech like Copilot directly into Microsoft 365. And get this, their Azure cloud revenue jumped 40% year over year, driven entirely by AI demand. To keep that commanding lead, they're shelling out roughly $35 billion a quarter on infrastructure.
Then we have Alphabet, offering a deeply diversified entry point. They're weaving AI into a massive ecosystem: search, YouTube, Android, Google Cloud, you name it. And they've aggressively fought back for market share with their Gemini models. Backed by a whopping $128 billion in operating income and their own custom TPU chips, hardware built from the ground up for AI, they give investors some amazing long-term optionality, especially with futuristic plays like Waymo autonomous driving.
Coming in at number 4 is Advanced Micro Devices, or AMD. Think of them as the primary challenger. Look, cloud providers are actively hunting for cost-effective alternatives to Nvidia, and AMD is aggressively closing that gap. Their MI450 chip is stepping up as a formidable option. Management is projecting 80% annual growth for their AI solutions, and what value investors really love is that AMD is trading at a much more attractive 32 times adjusted earnings compared to its peers.
Finally, we have Palantir Technologies. This is a fascinating contrast because they are a pure-play AI software stock. They're helping enterprises extract real, actionable insights from massive datasets. And wow, their U.S. commercial revenue is absolutely soaring at 121% year over year. But here's the massive warning label. It trades at a staggering 115 times sales. That literally makes it the most expensive stock in the entire S&P 500. It's a classic case of breathtaking growth meeting a sky-high premium valuation, meaning they need absolutely flawless execution to justify that risk.
Section 4, Risk Management with ETFs, building a balanced, defensive AI portfolio.
Okay, pivoting back to capital preservation. Remember, this explainer is strictly educational, not financial advice. But if you want to ride this explosive growth while dodging severe single-stock volatility, broad AI ETFs are a much safer harbor. Individual stocks give you high upside, sure, but they come with extreme concentration risk and demand constant monitoring. ETFs, on the other hand, track established indexes like the Index Global Robotics and AI, instantly spreading your risk across dozens of companies.
Financial advisors actually often suggest capping your individual stock exposure at just 10% of your portfolio. To navigate this safely, keep these 4 steps in mind. 1. Diversify across the whole value chain: chips, cloud, and software. 2. Seriously scrutinize valuation multiples before jumping in. 3. Follow the money, track that $405 billion capex trend to see who is actually cashing those checks. And 4. Maintain a multi-decade perspective. Guys, this is a marathon, not a sprint.
Section 5. Leading the AI Revolution, the 2026 Market Summary.
Here's the absolute core takeaway for today. The true leaders of this revolution, they aren't just the ones creating the flashiest tech. They are the ones proving right now that they can successfully monetize these massive infrastructure investments. Companies like Nvidia and Microsoft are leading the charge precisely because their real-world applications are actually justifying those monumental multi-billion-dollar capital expenditures we talked about at the very beginning.
So as we watch this $1.8 trillion industry unfold, you've got a major question to answer. Is the undeniable macroeconomic data around infrastructure spending enough for you to confidently navigate the valuation risks ahead? How are you balancing the fear of an AI bubble with the fear of missing out on the biggest tech shift since the internet? Because the money is already moving. Take these insights, apply them to your own strategy, and above all else, protect your capital. Thanks for tuning in to this explainer.